I hope you are locked in and ready to go for tomorrow. We are going to get a data dump with 3 major important pieces of economic data. This will change, potentially, or confirm the current market narrative. In English, we're either going way higher tomorrow or way lower. I'm going to run through Wall Street's estimates of this data, what I think the data is going to say and what the numbers are ultimately going to be, what kind of effect this could have on Tesla stock and to our broader markets. On top of that, we're going to get into what analysts are saying about our current markets as well as Tesla stock. We are seeing some option activity today that is not exactly encouraging, but to some degree expected before a major data dump, when that data dump has big implications for Tesla stock. So you guys do not want to miss this video. Tomorrow is going to be epic. We're going to get you prepared for it. Hit that like button and subscribe to the channel if you guys have not done so already. Thanks for watching and provide your opinions down below in the comment section. I would love to hear your opinions on my opinions on the economic data tomorrow. Let's go ahead and get into it. This says investment banks and asset managers have widely varying stock market and currency calls for 2024, reflecting deep division over whether the U.S. economy will enter a long-heralded recession and drag the world with it. I think these 2 quotes summarize our markets perfectly and why tomorrow is going to be so important. Quote, whether the U.S. has a hard landing or soft landing will dominate the market, says Chief Investment Officer at Legal and General Investment Management. Quote, the narrative isn't clear yet, she added, noting that if current interest rate forecasts were to shift significantly, that creates significant volatility. Options trading data shows investors are becoming increasingly interested in protecting their portfolios from heightened stock market volatility ahead. So you are seeing more calls being placed on our markets. We even seen that today in the VIX. The VIX was up about 1% heading into tomorrow's big data report. Even though the NASDAQ was up 1.28%, the Russell was up over 0.5%, the S&P was up 0.75%. To see the VIX actually green today is showing you something. There is a lot of people that are hedging out their portfolios right now, and I think that is notable. JP Morgan views a recession as possible, while Goldman Sachs sees only limited recession risks. Bond giant PIMCO puts the probability of a U.S. recession in 2024 at 50% and recommends government debt over equities. So the point is, there is a lot of varying opinions on our economy, on where things are going next, whether we're heading into a recession currently, whether it's just going to take a while to actually play out, whether or not we're going to know if we're heading into a recession or not. That's why tomorrow's economic data will be so important. We will have more clarity, more definitive evidence to point to say, hey, we're probably heading into a recession, or we're probably going to avoid a recession. Tomorrow, 8:30 in the morning, we are going to get non-farm payrolls for November. Now, we got the ADP employment change that came out on Wednesday. Markets were expecting 130,000 job ads. That number came in at 103,000 job ads. So it was slightly below estimates, but not negative, not even close to negative. So what did that support? It said, hey, we're not rapidly seeing job growth, but we're also not seeing a huge slowdown as well in the labor market. That's great news as inflation continues to fall. Now, tomorrow, Wall Street's estimate is 180,000 job ads. I'll tell you right now, if we come in over 180, probably not going to be great. If we come in around 180, it's going to be as expected, and I think markets will probably do okay on that. You probably wouldn't get a huge reaction in either direction. Now, if non-farms come in, let's say 160,000 or 150,000, I expect that could change the narrative for the markets. That would be just strong enough where we're likely not heading into a recession. 160,000 monthly job ads is the historical average of the US. So that would just put us back to the average over time. And that would really reinforce potentially you want to own equities, that we probably are not heading into some kind of imminent recession. Now, to the contrary, recession fears will be awoken if we come in less than 100,000 job ads. This would probably push up the odds of more rate cuts in 2024, but for the wrong reasons. See, you want rate cuts without a recession. If you're getting a bunch more rate cuts with a recession, that's a problem. We have recently went from pricing in 2 rate cuts in 2024 to 5, potentially 6 rate cuts in 2024, but that still is without a recession. So we really want to see that narrative get hammered home, that we can see a lot of rate cuts just because inflation is falling, that we're not expecting 5 or 6 rate cuts because of a recession. So let's summarize that a little bit, at least for the non-farm payrolls. A number that comes in too low is bad news. That's very recessionary. Shows that we might be heading into a recession as we, are speaking, right? A number too high shows that there's probably more work the Fed needs to do. A number that is slightly underestimates is really Goldilocks, where you want to be. My opinion, that's around 150 to 160,000 job ads. That's probably where you're going to come in, around 160. Would I be surprised if we came in at like 140 or 130? No. Would that be seen as good news? Probably. Anything like under 100,000 could be bad news. 80,000, 70,000, 60, 50,000, that's probably going to be bad news. Now, we are also going to get the unemployment rate for November. This is where things get a little bit tricky because any time in history we have seen the unemployment go up a 0.5%, we've went into a recession. So we were at about 3.5% unemployment for a while. Now we're at 3.9% unemployment. The estimate is 3.9%. If we go to 4, that's not too bad. But if we go to 4.1 or 4.2 coming tomorrow, that's not great. I would expect stocks to sell off on that because that would be further evidence that we are heading into a recession. Now, if unemployment actually falls, let's say to 3.8%, that could be very good news for our markets. Now, it's hard to put an estimate on this because you just never know. We have risen a lot recently. From, like I said, around 3.5% to 3.9% recently. So, it's a toss-up. It definitely is a toss-up. We could come in at 3.9%. We could come in at 4%. We could come in at 3.8%. That's really my estimate. I'm not expecting a huge move up or huge move down, but a slight move up or down. So I think the non-farms might be a little bit more important here. But if I were to estimate, we probably come back to 3.8%. That's where we were in August and September. Just in October, we did jump up a little bit. I wouldn't be surprised if we come in around 3.8% for the unemployment rate. We are also going to get a lot of other data in regards to the non-farm payrolls, like average hourly earnings, month over month, year over year. Depending on what those numbers could come in as, that does have implications for wage inflation. For average hourly earnings, month over month, you're expecting 0.3% of a gain. Last month was 0.2%, so that would be an increase. Not that great. You obviously don't want to see that because then the market say, hey, wage price spiral could be coming. Average hourly earnings year over year are expected at 4%. That would be down from last month's reading at 4.1%. That could be some good news. Participation rate expected at 62.7%, in line with what we seen last month. Average weekly hours expected the same as last month at 34.3. Government payrolls expected at 30,000. That's important too. A lot of your non-farm payroll reports that we have seen over the past year, a lot of those jobs have been government jobs. A lot of people have made the argument that if you take out government jobs, we would have been way lower on a lot of our reports. So we are expecting a downturn there. We'll see how that does affect the overall number. Manufacturing payrolls last month was negative 30,000. This month, we're expecting positive 30,000. That could be a good sign for the economy as manufacturing has long now been in a recession. Non-farm payrolls private expecting 153,000. That would be quite the jump from 99,000 we seen last month. And the U6 unemployment rate, this is workers that are working part-time looking for full-time work that are unable to find it. That's expected to jump to 7.3% from 7.2% last month. So notice how the U6 unemployment rate is a lot higher than the other rates, and this has been moving higher from 6.5% back in December of 2022 to 7.2% here recently as of October. It seems like a lot of people working part-time having a hard time finding full-time work. The next big set of data will come out at 10 o'clock in the morning. So you are going to have like an hour and a half gap here. It'll come out at 10 o'clock in the morning, the Michigan Consumer Sentiment Survey. This is probably the most well-respected survey in the world. It's been going on for a very long time. Michigan College does this, right? Now, the headline number doesn't matter too much. You're expecting 62. Last month was 61.3. So you are expecting a little bit of an improvement here. But your 5-year and your 1-year inflation expectations, those are the things that really matter. Now, what's really weird is while inflation has been falling, inflation expectations via this survey have actually been rising, which is typically not what you would expect. So 5-year inflation expectations are expected to rise from 3.2% to 3.3%. Take a look at what's happened with this. You were at 2.9% for a long time in 2022 and the beginning of 2023. You started to rise a little bit. April, you jumped to 3%. May, you jumped to 3.1%. Then you were back at 3%. And then you fell to 2.8% in September of 2023. October rose to 3%. And November rose to 3.2%. This is the highest you have been for 5-year inflation expectations via the Michigan Consumer Sentiment Survey in the last 10 years. This is the highest you've been in 10 years. Now, the highest you've seen over the past 25 years is around 3.4%. So if you see a big jump here again, well, that's not going to be great. But still, you can see this chart, right? Since 2020, these expectations have been rising. You peaked out at some point in 2021. You started to fall, and now you're rising again. So you have higher inflation expectations now when inflation is around 3 odd percent compared to when inflation was 9%. That's strange. Really, really strange. So markets are watching that closely. The 5-year is a little bit more important than the 1-year. The 1-year inflation expectations are expected at 4.5%. This has just been more elevated. The highest you were at was 4.6% in April of 2023. So unless you get some kind of huge jump here, I'm not expecting this to be all too big of a deal. You can see we were much higher in 2021, in between about 5.5%, 5.4 to 5.5% in that range. But 5-year inflation expectations are definitely a huge head scratcher, to say the least. You're also going to get consumer expectations. That's expected to actually get a little bit better from last month to 57. Michigan current conditions expected at 68.5 from 68.3 last month. So some couple, small data points here. I don't think inflation expectations are likely to go up again. I think you're probably going to come in line with what you've seen last month, around 3.2% for the 5-year and around 4.5% for the 1-year inflation expectation outlook. So a brief summary of what I'm expecting from the economic data. Non-farm payrolls likely to come in around 140 to 160,000. I'm not expecting a beat of estimates. I'm not expecting a way under number as well. 140 to 160, that's what I'm expecting. Unemployment rate could come in at 4%. It could come in at 3.8%. Could come in at 3.9% too, but I think you're probably going to see a down move from last month or a slight up move in the unemployment rate. Now, if you're adding 180,000, 160, 140,000 jobs, it's hard to make the argument that unemployment is likely to rise again, but we've seen that happen before, right? So I'm expecting potentially even a drop to 3.8% with the unemployment rate. Those two data points, let's say we come in at 150,000 job ads, 3.8% unemployment, that would be a Goldilocks-like data report. And if your 5-year inflation expectations and 1-year inflation expectations come in line with last month's numbers, that's overall a Goldilocks data report. And what is that going to do for stocks? Well, it is going to potentially change the narrative from maybe we're going into recession to, the soft landing is becoming more obvious. What does that mean? That means some of your money on the sidelines might start to make its way into stocks. Money that is in money market funds, which totals around $6 trillion, might start to come back into stocks. And now it's $14 trillion. So it went up again from 5.9 trillion to 6.14 trillion. That's insane. Now, where do you think all of this money is going to go? It's going to go into interest rate sensitive names. If we truly avoid a recession, it's going to go into the names that have been very feared over the past couple of years. Tesla down 45% from all-time highs. That's a very interest rate sensitive name that has moonshot like upside from here, that is very high quality with very little debt, that is self-financed, right? Tesla is your ideal name in which you would want to deploy capital if we actually avoid a recession in 2024. So if the data comes out as I expect, Tesla could have a very strong day tomorrow. 4 to 6% would be expected. Your IWM, your Russell 2000 names would also likely see a rally. Now, let me break it down like this. IWM is lower today, pricing in 5 or 6 rate cuts than where you were in July when markets are rallying solely based on AI hopium and you were only pricing in about 2 rate cuts for 2024. So now you're pricing in more rate cuts. If a recession looks like it's not coming, well, hey, that is going to be a reason, a big reason to buy the Russell. And I think it's kind of like a rubber band right now, right? Rubber bands snap back to the middle. If you pull it out, it snaps back. I think right now, the rubber band is really stretched on the Russell. There's a lot of people that want to pull the trigger, that want to get in small caps, mid caps, interest rate sensitive names, but they just need a little bit more confirmation that we're not heading into this imminent recession. And I think tomorrow is going to paint the picture that the economy is holding up, that we're pricing in 5 or 6 rate cuts because inflation is falling so aggressively. Inflation falling, pricing in 5 or 6 rate cuts is a lot different than a recession pricing in 5 or 6 rate cuts. Today, hedge funds and institutions placed 654 option trades totaling $1.5 billion with a positive order value of 22%. So the option activity in Tesla today was pretty bearish. That is almost expected heading into a big potential moving catalyst coming tomorrow. So although it is pretty bearish, it's pretty expected if tomorrow's data can have a big possible reaction to Tesla stock. Some hedge funds and institutions definitely want to hedge out their portfolios, but over the past week, you have seen 5,051 different trades totaling $10.78 billion with a positive order value of 52%. Options are normally to hedge out risk, right? Options were created to hedge risk. So considering that, this last week has still been very positive for Tesla. Again, considering the just amount of risk tomorrow could bring for our markets. Overall, if we look at the charts with Tesla, Tesla was up 1.37% today and after hours up 0.12%. You did get rejected at that 100-day moving average again. I think tomorrow you firmly break above the 100-day moving average, probably into the 250s if tomorrow goes good as I expect. If tomorrow is bad for whatever reason, you probably fall back to around $234, this 50-day moving average. If you don't hold support at the 50-day moving average, that's going to be telling you something. That's going to be saying, hey, the dynamic in the markets have shifted. We're now expecting a recession. And I think the only way we get that big of a down move is if the jobs report comes in way lower than expectations. At this point, as inflation is falling, it's better to have a 250,000 jobs number than a 50,000 jobs number, right? You would rather way beat the estimates than way underwhelm the estimates, because that's the point. A recession is the number one thing markets fear. So we just need to avoid that. And in a weird way, a really strong jobs report would, be saying to the bears, you're dead wrong. We're not heading into a recession. So higher is better than lower, but preferably you want to be slightly lower than Wall Street's estimates, around 140 to 160,000. In that case, I would expect Tesla could rally into the 250s. But again, worst case scenario for tomorrow is around the 230s, potentially as low as 230 itself. But that would be a really big down move coming tomorrow. I think arbitrarily, you could even look at the markets today and say, look at the outperformance in the NASDAQ, in the Russell, the S&P, everything did good today. Maybe that's a precursor because the data tomorrow is going to also be strong. Let me know what you guys think down below in the comments section. So that is going to do it for this video. Hit that like button and subscribe to the channel if you made it to the end of this video. If you guys also want to take it a step further and come trade with us live in real time, come get access to all of the notifications I put out almost each and every single day. I did make a trade today on IWM for the data coming out tomorrow, so I put about $1,000 behind what I'm saying here in this video. So if I'm wrong, I'm going to lose money tomorrow as well. If you guys want to come see that trade and others that we make over time, come get involved, come ask questions, all of that, link down below in the description of this video. Thank you for watching. Enjoy the rest of your day and night, and I will see you in the next one.